this week there's been published a headline from the Economist magazine on its front page asking the question, how high can these markets go? Well, it's a big question, and how close are we to the top? Our guest for the next 5 or 10 minutes is Joachim Klement. He's head of strategy at Liberum. He joins us now with some more and might be able to shed some light on this burning question. Joachim, welcome. We've been talking a lot about what's been driving these markets. What are your thoughts on where we are, the sort of price action we're seeing, and whether or not you're happy about continuing to back these markets on the upside?
Yeah, well, I think in the very short term, over the next month or two, I would be cautious about the US market and equity markets in general. We've now reached, again, very overbought stances in the US, in the Nasdaq, even more so than in the S&P 500. And I would say we are due for consolidation. However, looking further out, 6 months into summer or then into the year end this year, I remain bullish on US stocks and European stocks alike. The US earnings season that has basically completed by now has again been quite strong, not just in the famous Magnificent Seven and in the tech sector, but pretty much most sectors have seen earnings growth faster than in Europe and a significant amount of positive earnings surprises, all of which means that the underlying dynamics of the fundamentals remain intact for now.
How nervous are you about the market rally when you talk about the Magnificent Seven, because so much weight has been added to these great behemoths in the market, the Apples, the Microsofts, Amazon, Meta, Google, setting aside Tesla, because I know that's a bit of an underperformer. But there certainly seems to me that there's a concentration here in too few stocks. The breadth is so narrow. Is this unusual given where we are with this rise in equity benchmarks?
So for the US, the market concentration is unusual if you compare it to its own history. In fact, I just updated my numbers this morning, and we are now at the most concentrated markets in the US in at least 30 years, as far back as my data goes. However, if you compare it internationally, obviously smaller equity markets with fewer stocks in them are more concentrated. So in that respect, the US is not unusual. However, what the unusual concentration of the US amongst those super mega caps means is that if they start to disappoint, if their earnings growth starts to slow down, that will have an outsized impact as well on the way down, as it does now on the way up. But as I said, for now, the way down is probably more than 6 to 12 months away from us.
Yeah. How sensitive are the markets and this market move to what the Federal Reserve is doing? So saying the markets, I think at the moment, looking like they're expecting an interest rate cut from the Fed by 25 basis points come June. If there's any hint from the Fed that that is not going to be the case, to what degree do you think this will be felt in the markets?
Yeah, I think what we've seen in January, February was, especially in the first half of January, a little bit of a consolidation on the back of markets being kind of disappointed that the Fed would not move aggressively towards cutting rates. I think most investors have always kind of expected the rate cuts to be in the second half of this year. This is what's now priced into equity markets. But if the Fed indicates that the first rate cut will not be in June, but possibly even in August or September, that would probably lead to a 5% plus correction in equity markets as investors readjust their expectations for the support that we all hope we will get in the second half of this year from rate cuts.
Let me just return to the charts if I can and bring up this chart of the dollar basket, fourth day in a row of gains for the dollar basket. And of course, the best way and the most common way to trade this is what's happening with the euro dollar trade, which is the bulk of that dollar index, if you like. And of course, Joachim, when we're looking at interest rates, we've got to remember that the European Central Bank is also meeting on interest rates next week. To what degree is the situation slightly different there for the European Central Bank over the Fed? And could that disturb the euro dollar trade?
Yes, it could indeed lead to a weaker euro and a stronger US dollar in the next couple of weeks. And the reason why I say this is because the European economy is clearly in recession while the US economy is chugging along nicely. And that means that inflation in the Eurozone is much, much lower than it is in the US. And both wage inflation and inflation is trending lower faster than it is in the US. That gives the ECB room to cut interest rates, more room than the Federal Reserve has. And there's an outside chance that the ECB might start cutting interest rates before the Fed does. We, at this point in time, expect both the Fed and the ECB to start cutting in June, but it isn't out of the question that the ECB might already go in its April meeting. If that happens, that would obviously be very bearish for the euro and would probably move the euro-US dollar exchange rate towards a 105 handle.
Yeah, and just quickly referring back to the markets, I know we're talking mainly about US at the moment, but I do have to comment on what's happening on the European markets as well, because intraday today we've seen another new all-time record high on the German DAX. Same question about the DAX, the European markets, on the European interest rate outlook. I mean, if the ECB doesn't deliver, again, are we looking for a 5-10% retracement, or what's your feeling in terms of where we are on the European markets?
Yeah, same thing. It's buoyed by the hopes for interest rate cuts by the ECB. But what makes Europe even more vulnerable than the US to a short-term consolidation is the fact that the earnings growth and the earnings season in Europe was actually quite a bit weaker than it was in the US. So in Europe, the businesses are reporting much lower margins, much more margin pressure because of a lack of demand. And if you then get rid of the potential support from rate cuts, that would probably hurt the European stock markets more than it would in the case of the US.
Interesting. We'll leave it there, but thanks indeed for joining us. Joachim, it's been a pleasure talking to you. Thanks for your time.
Thank you.
That's Joachim Klement. He is head of strategy at Liberum here in London.